Are you tired of making poor stock investments? It's time to discover how to identify undervalued stocks and potentially earn significant profits. Just as we wait for discounts to save money on big purchases, investors seek out undervalued stocks to minimize risk and maximize potential returns. An undervalued stock is when its market price is lower than its perceived value. The key challenge for many investors is discovering these undervalued stocks. The solution? Utilize the stock screening techniques of renowned investors Benjamin Graham and Warren Buffett. So what is a stock screener and how does it work? The first step in finding undervalued stocks is to use a stock screener. A stock screener is a set of tools that helps investors quickly sort through many companies based on a few predefined criteria. Benjamin Graham, the father of value investing, made one of the first stock screeners. He used several metrics such as the PE ratio, debt-to-equity ratio, dividend yield, etc. to find undervalued stocks. Let's have a look at Benjamin Graham's stock screener. Benjamin Graham used the stock screener to find companies with a long history of making money, a strong balance sheet, and a low price. This method worked well in the 1930s and 40s, but stock screeners have changed over time to include more qualitative factors to help find undervalued stocks. Now let's have a look at Warren Buffett's undervalued stock screener. Warren Buffett, Graham's famous student, created one of the newer stock screeners considering more than just a stock's price. Buffett's stock screener is based on simple rules in 4 key areas: business, management, finance, and the market. After an idea of stock screeners, let's now discuss the 4 main steps for finding undervalued stocks. But before we move to the 4 steps for finding undervalued stocks, make sure to hit the thumbs up icon below to like this video. Step 1. Start by researching the company's financials. Before investing in any stock, it's important to analyze the company's financial statements, including its balance sheet, income statement, and cash flow statement. Look for companies with a solid financial position, a steady growth rate, and a low debt-to-equity ratio. For example, in the Indian market, one undervalued stock that has caught the attention of many investors is Hindustan Petroleum Corporation Limited, or HPCL. The company has a strong balance sheet with low debt, and its revenue and earnings have steadily increased over the past few years. Additionally, its PE ratio is lower compared to its competitors, making it a potentially undervalued stock. An investor can start by examining the company's balance sheet to assess its financial position, including its assets, liabilities, and equity. They can look at the company's cash flow statement to see how much cash is being generated and how it is being used. They can also examine the company's income statement to determine its revenue, expenses, and profitability. In addition to traditional financial statements, an investor can review the company's management and leadership, its industry position, and competition. They can look at the company's past performance, including its earnings and revenue growth, and assess its future prospects by analyzing its plans and goals. An investor can make informed decisions about whether or not to invest in a particular stock by conducting a thorough analysis of the company's financials and other data. This process can help the investor identify undervalued stocks with the potential for strong returns in the future. For example, if the investor identifies a company that has consistently shown strong revenue growth and positive earnings, but its stock price has lagged behind its peers, this may indicate that the company is undervalued and presents a potential investment opportunity. The investor can then continue researching the company and its financials to confirm the potential opportunity. Pay attention to market trends. Keep an eye on overall market trends and sectors that are currently performing well. This can help you identify which industries are more likely to provide undervalued stocks. One example of paying attention to market trends while finding undervalued stocks in India is by analyzing the performance of the Indian stock market and the economy. An investor can gauge the economy's overall health by keeping track of indicators such as gross domestic product or GDP growth, inflation rates, and consumer spending patterns. If the economy is strong, the stock market is likely to perform well, and investors may be able to find undervalued stocks that have the potential to generate strong returns. For instance, if an investor sees that the Indian economy is growing rapidly and consumer spending is rising, they may look for undervalued stocks in consumer goods and retail companies. They can also research companies and industries that are expected to benefit from economic growth, such as infrastructure and real estate. Once the investor has identified potentially undervalued stocks, they can analyze the financial performance and outlook of the companies, including earnings growth, revenue growth, and debt levels. They can also look for companies with competitive advantage, such as a strong brand or innovative technology, which can help to drive future growth and increase the company's value. By combining an understanding of market trends with a thorough analysis of undervalued stocks, investors can increase their chances of finding investments that generate strong returns over the long term. Step 3. Utilize valuation metrics. There are several valuation metrics that can help you determine if a stock is undervalued or not. Price to earnings ratio, price to book ratio, and dividend yield are all commonly used metrics that can give you an idea of a stock's true value. To start, gather a list of companies in the Indian stock market and their current stock prices and EPS. Calculate the PE ratio for each company by dividing the stock price by the EPS. Next, compare the PE ratios of these companies to the industry average PE ratio. A company with a significantly lower PE ratio than the industry average may be considered undervalued. Additionally, consider factors such as the company's growth potential, financial health, and competitive position in the market. A company with a low PE ratio but poor fundamentals may not be a good investment opportunity. Finally, make informed investment decisions by considering multiple valuation metrics and conducting further research on the company before investing. Number 4. Keep an eye on insider buying and selling. Insider buying and selling can strongly indicate a company's future performance. If a company's insiders are buying more shares, it's a good sign that they believe the stock is undervalued and will increase in value in the future. Keeping an eye on insider buying and selling can also be useful when finding undervalued stocks in India. Insider buying and selling are transactions made by the company's executives, directors, and other key employees. These transactions can give investors valuable insights into a company's future prospects. For example, if insiders are buying a large amount of stock, it can indicate that they believe the company's stock is undervalued and that it has good future prospects. On the other hand, if insiders are selling a large amount of stock, it can indicate that they believe the company's stock is overvalued or that the company may not have good future prospects. Investors can regularly check regulatory filings such as Form 4 filed with the Securities and Exchange Board of India or SEBI to keep an eye on insider buying and selling. These filings must be made within 2 trading days of an insider's transaction and provide details on the type, number, and price of shares bought or sold. When analyzing insider buying and selling, it's also important to consider the individual's role within the company, their history of transactions, and the overall trend of insider buying and selling in the company. For example, if a CEO has a history of consistently buying company stock and the trend of insider buying is increasing, it can be a good sign. It's important to remember that insider buying and selling should not be the only factor considered when making investment decisions. It should be used in conjunction with other tools and analysis, such as financial statements and market trends, to get a comprehensive picture of the company's future prospects. It would be nice to know that undervalued stocks will eventually do better than the market as a whole, but this is only sometimes true. Analysts always add new companies to their buy lists, but that does not mean that a stock you own or are thinking about buying will ever be on one of those lists. Finding undervalued stocks in today's market takes research, patience, and a willingness to take calculated risks. Always do your due diligence, analyze the company's financials, and consider market trends and insider buying and selling before making any investment decisions. Have you got an idea of how to find undervalued stock? Are you planning to invest in undervalued stocks to be a wise investor? Tell us in the comment section below. Thank you for tuning into Omega Finance's YouTube channel, and don't forget to like, comment, and subscribe for more financial tips and tricks. See you in the next video. We've also uploaded a video on the 5 best dividend stocks in India with high growth rates on our channel, which can be very helpful to you while investing in dividend funds in 2023 and beyond. You can find the link to that video in the description below and in the card.